Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. So another week in investment markets, and we continue to push to all-time highs. If you look at the S&P 500, for example, we're at around 3,386 as I make this video, pushing towards that 3,400 level. Now, if you'd talk to a technical analyst who was very bullish about the market, then perhaps the idea of being towards 3,400 already this time of year would be particularly surprising. And their longer term targets of maybe 3,500, which they would be thinking would happen maybe later in 2020, we could be talking about them happening within the next couple of months. Now that's all assuming that things go as planned and we don't have a downturn in economic activity globally. And that's the big question, because the coronavirus is still out there and we're still not sure exactly of the impact it's going to have on the global economy. We have a name for the virus now, COVID-19. It's probably easier still to call it the coronavirus when I do these videos. But we go from a period of almost daily flipping from the coronavirus. We've got good news around it. Perhaps the number of cases or the speed of the contagion is slowing in China. We still don't quite get the clarity of numbers that we would probably like, but we go from it being now positive to negative on an almost daily basis. We have some positive news that has actually come out about global activity in terms of the economic activity, but all of those numbers that you're hearing are pre the coronavirus outbreak. So we still don't know the precise impact that we're going to have on the global economy. And what was interesting this week is that Apple cut their guidance on their next quarter earnings. Now, that is very unusual. We did have it happen at the beginning of 2019 when they cut guidance centered around the trade war dispute between the US and China. But of course, the supply chain will be interrupted when they're trying to build iPhones, etc. So that has meant that they've cut guidance, which actually hit their share price, but it didn't hit it as much as you probably think it would. And in fact, their share price is back now pushing towards the recent highs that we've had in the last week or two. And if we go back to 2019, when they cut guidance the last time, yes, we had a bit of a sell-off in their share price, but their share price has risen almost 90% in the last year. So you can see that even with a cut to guidance, the bullish momentum of stocks seems to continue. And as the phrase is, as goes Apple, so goes the stock market. Apple is increasingly important to the future direction of the US stock market and therefore global stocks. Now, of course, against this slightly uncertain backdrop, continued all-time highs in stocks is actually bullish in itself. Now, when I did some research for 80/20 investor members, one of the things that the research showed is that typically if you get an all-time high in a stock market, it's not necessarily a bad thing. It's actually a bullish sign. And the next all-time high tends to, on average, come within about a week. Now, that's not saying you'll always get all-time highs every time after you've had one, because all good things do come to an end. And we are starting to see some divergences out there. I mentioned previously we've had the bond market still flashing warning signs. We've still got commodities like gold hitting all-time highs, and other commodities are still starting to hit new lows. And in fact, oil entered a bear market because of signs of slowing global growth, potentially around the coronavirus in China. But the problem is we don't have the numbers yet. So are we nearing a top for equity markets? We don't know. But in the next sort of few months, the next few weeks, when we start getting some economic numbers that are coming out of the Far East, and the impact on global supply chains from other companies, will we get further cuts to guidance from other companies globally? We might start to see that it's going to have an impact and the world might potentially enter a recession. In fact, Deutsche Bank even said that they thought that Germany could potentially enter recession in the first quarter of 2020. Now that's unlikely now because you need 2 quarters of contraction, and Germany just about hung on to a flat economy, so it didn't contract at the end of 2019, so they probably might just avoid a recession. But it shows you where we are now. Everybody's hoping that global central banks are going to save us all, and in fact China cut their interest rate today. So there's been so much of this stimulus that's going into markets that we're really betting or hoping that central banks can keep the market afloat, as they have done ever since the financial crisis. So the other thing to keep an eye on is breadth within the equity markets. So we're seeing the big names, so things like Amazon, a lot of the tech giants, we're seeing Microsoft, Apple doing a lot of the heavy lifting of the US equity indices. And of course, underneath that, we're seeing that this breadth is narrowing. And if it keeps narrowing, that means that the market is prone or more likely to pull back for at least a period of time anyway. So what we want to see is other sectors and other companies, their share prices rising to try and keep pushing markets higher and higher. And we're still seeing defensive sectors outperform, particularly utilities. And that's why my own 50k portfolio, which you can have a look at if you take out a free trial of 80/20 Investor, it's why that portfolio is doing particularly well at the moment, because although it still has a significant equity exposure, there is definitely a defensive tilt to it through things like REITs, which is real estate investment trusts, and utilities. And one last thing to keep an eye on is the pound. The pound has fallen against the dollar. It's crashed through that 130 level. It's down through $1.29. If we keep falling, then we could get into a slightly bearish pattern. But at the moment, there's lots of support around the level it's at, currently around about sort of $1.28. It'll be interesting to see what the Bank of England does in the coming months. So that is it for this week on Damien's Midweek Markets. If you want to get in touch, you can do the usual way. Damien at moneytothemasses.com is the email address. Twitter, Money to the Masses. Of course, you can find us on Instagram and Facebook. Make sure you join our Facebook group if you have any questions or topics you want to discuss with other members. And of course, subscribe to our YouTube channel.